is Anat Bernstein-Reich. I'm the chairperson of the Israel-India Chamber of Commerce. I'm also the vice president of Israel-Asia Chamber of Commerce. And every year we would like to hear from you, Dr. Ghosh, what are your projections for the coming year? And last year it was a very successful gathering, so we asked you to join us again. And thanks for generosity of our friends in SBI. Singla, Ambassador of India to Israel. Please, Mr. Singla.
Thank you. Thank you, Anat. Namaste and Shalom. Dr. Soumya Ghosh, Chief Economic Advisor to State Bank of India. Mr. Nageshwar, DMD International Banking State Bank of India, who's joined us from Bombay. Mr. Ramana, who heads the State Bank of India in Israel. Our friends from Israel-Asia Chamber of Commerce and Israel-India Chamber of Commerce, the State Bank of India, and the Israel-Asia Chamber of Commerce on the Indian economy with a special focus on the budget, as Anat said. Well, I have no hesitation in saying that the big story on the Indian economy has three main points. One, the government has utilized the COVID-19 pandemic to make the Indian economy more resilient and competitive by effecting various reforms, including the first major factor reforms since 1991, and I'm referring to labor reforms here. Two, the Indian economy has had one of the sharpest V-shaped rebounds among all the major economies in the world. The GDP growth beat market predictions for the second quarter, and now for the third quarter, it has turned positive. The IMF has forecast the growth to be over 11% for the next fiscal, which is perhaps among the highest among the major economies. The sentiment on the ground is good, and there has been a sustained increase in the goods and services tax collections. And further, given India's huge size, we've done reasonably well on tackling COVID-19. We were able to delay the peak to mid-September and have brought down a steady, sharp decline in the cases since then. In September, we were witnessing about 100,000 cases a day. These cases were down to about 10,000, 12,000 daily until about 10 days ago. And most of these cases were further concentrated in two states only. Our vaccination program started a month ago, and it has finished its first phase. We have begun the second phase of vaccination today, and it's likely to see a much more rapid rate of vaccination than the first phase, now that the private sector has been involved in a big way. We've seen a small uptick in COVID cases in the last few days, but it remains to be seen whether it becomes a second wave, something that we have managed to avoid so far. And three, the government has presented a landmark budget a month ago that provides for a demand stimulus through a major expansion in government spending with a special focus on infrastructure. It marks a directional change for Indian economy in the stress it gives to the private sector as driver for growth. And I will leave it to Dr. Ghosh to elaborate on the six main pillars in the budget proposals. To me, however, the main features are A, the increased emphasis on health and well-being spending, B, the capital expenditure budget that has been increased by over a whopping 34%, and which is particularly targeted at physical infrastructure like roads, railways, metros, and ports, and which will have a major multiplier impact. C, the proposals to establish a developmental financial institution and monetization of brownfield assets that would help funding for the national infrastructure pipeline. D, the enhancement of permissible foreign direct investment limit in the insurance sector to 74%. That will permit foreign ownership and control with safeguards. And E, the proposals to establish a bad assets bank, privatize two public sector banks and one insurance company, and also do an IPO of the Life Insurance Corporation. In addition, there are important changes in company law that Dr. Ghosh can elaborate on. I would also request Dr. Ghosh to particularly highlight the production-linked incentives or the PLI scheme for the benefit of our Israeli friends today. So once again, I thank you for your time, and I have no doubt that you will have a very productive afternoon listening to Dr. Ghosh. Thank you.
Thank you, Mr. Ambassador, and thanks also to our DCM for joining us today. Hello, ma'am. We have with us Mr. Ramana, which is the CEO of State Bank in Tel Aviv. We have with us Mr. Sivi Nageswar, DMD of International Banking from Bombay. We have with us Mr. Raviv Byron that will give us vote of thanks at the end. And we have our friends from State Bank in Israel and in India. I'd like to pass the mic to you, Mr. Venkat Nageswar, DMD International Banking at State Bank. Please, Mr. Nageswar.
Thank you, Ms. Anat. His Excellency, Mr. Sanjeev Singla, Ambassador of India to Israel. Ladies and gentlemen, good afternoon to all of you. It's wonderful to have you all in this all-important virtual seminar to decipher and dissect the Indian Annual Budget 2021 and 22. In fact, I thank Israel Asia Chamber of Commerce for making me a part of this particular seminar. The outbreak of COVID-19 in China in January 20 and its rapid spread across the globe has created an unprecedented economic crisis. We are now in the 15th month since the outbreak of it was declared pandemic by World Health Organization. The pandemic continues to keep the world on the edge with uncertainty about flattening of the COVID curve due to various mutations of virus like UK strain and South African strain. Have arrived, is being done. World over, there is no consensus on this efficacy. The fate of economic recovery and protection of lives and livelihoods continue to remain uncertain. As the pandemic ravages on, the economic impact is hard to measure. Although there are green shoots and some businesses are coming back to the pre-pandemic level, the uncertainty over the length and the intensity of pandemic and its impact on the economy continue to cause concern. In the wake of this pandemic in India, the Reserve Bank of India, the regulator, the banking regulator, had stepped forward and so far announced various liquidity, monetary, regulatory, and supervisory measures in the form of interest rate cuts, higher structural and durable liquidity, moratorium on debt servicing, asset classification standstill, and recently a special resolution window within our prudential framework for resolution of stressed assets. The new year 2021 has begun on a very strong positive note, like what our ambassadors talked about with vaccination drives in major economies as well as in India. The outlook on the growth in Indian economy has improved significantly with the positive growth impulses becoming more broad-based and the rollout of vaccination program in country agreeing well for the end of the pandemic. The economy exited the recession and grew by 0.4%, which our ambassador had very clearly articulated in the Q3 of financial year 2021, after contracting 24.4% in Q1 and 7.3% in Q2. India is now one of the major economies to post growth in the last quarter of the calendar year 2020, with improvement in economic performance inversely tied to the drop in COVID-19 infections, which again, our ambassador has very clearly articulated. Inflation in India has returned within the tolerance band. In fact, Reserve Bank of India has got a tolerance band of 4% plus or minus 2%. And now it has come within the particular band. And the RBI feels that the need of the hour is to continue to support growth, assuage the impact of COVID-19, and return the economy to higher growth trajectory. The RBI survey points towards the improvement of capacity utilization of manufacturing sector to 63.3% in Q2 from 47.3% in the preceding quarters. Consumer confidence is also reviving and business expectations of manufacturing, services, infrastructure remain upbeat. The movement of goods and people and domestic trading activity are growing at a robust pace. electricity and energy demand reflect a broader normalization of economic activity than in December, even as the fears of second wave abate. Data of sales and new launches of residential units in major metropolitan centers reflect a renewed confidence in the real estate sector. Faced with this daunting task of pulling back the economy from the clutches of the degrowth, Honorable Finance Minister had presented the budget, and which is based on 6 pillars, which again our ambassador had very clearly articulated, and of course our Dr. Soumya Ghosh is going to spell it out. As mentioned again, it has provided a real impetus on the sectors such as health and well-being, infrastructure, innovation and research, among others. These are going to have a cascading multiplier effect going forward, particularly in improving the investment climate and reinvigorating the domestic demand, income, and employment. The budget proposals address the challenges created by COVID-19 pandemic and have skillfully addressed the demand side by expanding the role of government through a sharp increase of 34.5% capital expenditure over 2020-21 to rupees 5.554 lakh crores. The investment-oriented stimulus under Atmanirbhar 2 and 3 has started working its way and is improving the spending momentum along with the quality of the public investment. Both will facilitate regaining India's growth potential over medium term. Indian banking and financial system has displayed tremendous operational resilience in the face of COVID and lockdowns. Going ahead, financial institutions have to take a tightrope walking for nurturing the recovery within the overarching objective of preserving the long-term stability and financial systems. One important point I would like to bring out here is the last Q3 results of State Bank of India, which is considered as a proxy to Indian economy, has beaten all the analyst expectations and has shown that the worst for the bank is over. The asset quality has improved sequentially, even after the accounting for the standstill loan recognition given by the Supreme Court. SBI has reported robust operating performance in a challenging environment. The loan growth has shown a healthy growth in the retail portfolio, the disbursements in the new business segments surpassing the pre-COVID levels. With all these positives, I have no doubt in mind, as what clearly articulated by His Excellency the Ambassador, that we are going to see a V-shaped recovery in the Indian economy and propel the Indian economy to a greater heights after a tumultuous year. So I leave the floor to Dr. Ghosh to present the budget before this August audience. Thank you very much. Stay safe, stay healthy, and namaskar.
Namaskar. Thank you, Mr. Nageswar. You sound optimistic to me. We have several collaborators in this seminar today, in addition to State Bank and the Embassy of India in Israel. We also collaborated today with the Manufacturers Association of Israel, and I believe that Mr. Daniel Kטריבס will join us later. And we have also Advocate Benjamin Grossman from APM. Benjamin, can you say a few words to the audience?
So first of all, welcome. I'm also sharing the optimistic point of view about what will come ahead in the next year. Winston Churchill said once, you cannot afford wasting a good crisis. We are now in a crisis, but I think that both India and Israel entered this crisis in a relatively good condition. In the strength and unemployment, all those indicators, and also both countries, each for its own reasons, are quite among the first to get out of the crisis. In India, so there is some kind of immunity. The numbers of new cases, I understand, is not increasing. In Israel, we are doing good job with the vaccination. So I believe that when the dust will go down, India and Israel will be among the first to be in a relatively better condition than the others. And when I'm adding this to the traditional collaboration between the countries, the culture of collaborations, I think that the way out of the COVID crisis, and it is a crisis, creates a huge opportunity for collaboration between the two countries. I read the highlights of the budget. I think that Israeli companies have a lot to offer to self-reliance India philosophy and other main issues as well that will govern the way out of the COVID in 22, 23 and ahead. And I think that we have a great team that can materialize that into business. So just we have to start the business itself. Thank you.
Thank you, Mr. Grossman. And just a sec. Now we will hand the mic to you, Dr. Ghosh. Just hold on.
Danny, join us.
Danny Katarevis is with us. Danny, why won't you say one word before we head to our keynote today?
No problem. I was actually one of the listeners, and you made me now a member of the panelists, so thank you very much. So I've listened both to the ambassador and to the Bank of India. I just want to say that, again, on behalf of the Manufacturer Association, we see the relation with India as strategic relation, and we are backing all the activity of the Chamber, which is doing an excellent job, headed by Anat, and we are all eager to listen and to learn more, because I think that definitely Israel and India are complementing one another, and we definitely encourage all our members to look into India and to see what can be done with India, because the world is changing and India is becoming a rising star that we want to be linked to. So thank you very much, and we are all here to listen to you.
Thank you, Danny, for joining us today and for being such a great partner for our chamber. And the mic is yours, Dr. Soumya Kanti Ghosh, Group Chief Economic Advisor to State Bank of India. And for those of you who don't know, we have a branch of State Bank in Israel. So if you missed this point, it is a major point. The bank is accessible to you here in the Diamond Exchange Complex in Ramat Gan. Dr. Ghosh had his PhD in economics from GNU in New Delhi. Previously, he was a senior fellow at the Indian Council for Research on International Economic Relations. The mic at last is yours, Dr. Ghosh.
Yeah, thank you very much. And Your Excellency, the High Commissioner, Mr. Singla, and also the participants and at this panel. And what I will do today is that I will actually take you through the budget presentation. It's a longish presentation, so I will try to make it as quickly as possible. Then after that, I may take a few questions so that there is, so that's where I have to round it up. So before I ask my team member to share the presentation, just one sort of data which I want to share with you. Today morning, there was these GST numbers were due for the month of January, and we had actually tweeted, I had tweeted that this numbers is going to be very strong, and for the 5th month in a row, it should be around 1.15 lakh crores. So the number just came in right now, 5 minutes back, it is at 1.13 lakh crores. So basically the numbers are continue to remain very buoyant, and the budget which has been presented actually gives and is actually says a lot of things. And for the first time, the budget, what is saying is that it actually is under delivering, but it will basically over deliver but under promising. So every time when you go through any of the documents of budget and like that for any government, it always over promises and under delivers. But this is exactly the opposite. It is under promising but over delivering, because all the numbers and the trends which is coming out from there in terms of the fiscal deficit numbers, that actually shows that the budget numbers are going to be very pragmatic and reasonable in this year, and that's why the markets have given up a thumbs up to the entire budget. Now let me start with the presentation. Yeah, I think I have shared my screen is visible. Yes, so let me just go out quickly. I think I'll start with a very small couple of slides on the SBI Q3 result, because State Bank of India is 20% of India's GDP, and it's 20% of India's GDP, and so therefore it's actually it gives a parameter of the economy. And in the last results, which was published as early in the first week of February, the credit growth was actually back to pre-COVID levels. Then there was a significant improvement in the asset quality. I mean, the restructuring applications, and this, if you remember, there was a lot of noise when the pandemic had started, saying that there will be a lot of asset quality issues with the bank. But today, when I look into the numbers and the restructuring requests, which has come to the banks, that is actually minuscule, and that shows that the banking sector is likely to show the most positive surprise in the current fiscal. And in fact, even the international rating agencies, even if all the forecasters who are having a field day, this is not a strong word, I'll use a rather strong word, who are having a field day in including noted persons, field day about the Indian bank's asset quality at the beginning of the year. I think now everybody is saying that the Indian banking sector is going to surprise the most positively. This includes the Standard & Poor's, this includes Moody's, and this includes everybody. So that's the most surprise. The provisioning coverage ratio of the banks are at significantly higher levels. That means everything is provided for, so nothing has to be provided. And there has been a significant digital experience on the part of the banks. You must remember that in the month of July, when the pandemic was at its peak in India, almost the maximum growth in the retail loans took in the month of July 2020, the current fiscal year, which shows that how the Indian financial sector has onboarded the digital transformation, of course, with which SBI is also a part. So this is the most important thing. Then this I will not get into the key financial ratios. All are showing healthy growth, but the credit deposit ratio is actually a 60 to 65%, which means, and given the sufficient liquidity and headroom, there is to be a significant credit growth in the next year. And I will give you our forecast for the next year growth very quickly. Now, if I start with the global and the Indian economy, and the first thing about the global and the global economy is that I think at the beginning of the year, the global output is now estimated to decline by 3.5 to 4.3%. But the important point is that the recovery has been strong across the globe and is projected to grow 5.5% and 4.2% in 22. But there are some downsides. For example, of course, it will accentuate some inequality. There has been a lot of talks that people will get into, below the poverty lines. So that is one of the concerns which remains. But the other good thing is that, but the other problem is also there has been a significant shock to the service sector. As all of you know that one of the more basic problems with this pandemic is that when the pandemic, and how it is different from the earlier crisis is that the service sector, the manufacturing sector, which is basically the manufacturing sector.
You're saying I should address it to this guy.
Yeah, the manufacturing sector, which is actually showing the recovery, is because of pent-up demand. But the problem is with the service sector, because in the service sector there is no concept of pent-up demand, because if you have missed a vacation 2 months back, if you have missed a meal 2 months back going up to a restaurant, you cannot have 2 meals and 2 vacations today. So that's where service sector, what is pent-up demand has gone. So that's the problem with this financial crisis, and that is also one of the reasons why the Indian economy is going to contract by 8% this year as per the CSO estimates, which was released last on February. And again here, I'd like to say that this estimate is basically an overestimate. And when the final numbers are announced in May, will actually see a much better number. Global trade in goods and services have also declined in 2020. And annual growth in global trade is forecast strongly in 2021 and in 2022. So basically the global outlook actually looks a little promising, and global economies have recovered much faster than what we're anticipating. There's some facts about the Indian economy, which actually is significantly important over here. India's is the 5th largest and one of the first growing economies. IMF is projecting a growth of 11.5% for India in 2021. Interestingly, we had projected a growth of 11% before the IMF had projected 11.5%. And I think this 11% projection, which we had made, could be even higher than 12 to 13% next year. The total FDI flows has been more than 70 billion last year. India has a young population. The national infrastructure pipeline will attract investment so that the 5 trillion economic dream of FY25 is there. Of course, there could be some plus minus because of the pandemic, but that 5 trillion is just a number. India has jumped 79 positions in the World Bank Ease of Doing Business. Global Innovation Index, India has jumped 4 positions, is now in the 48th position. And for the first time in 18 years, India's current account surplus will remain in surplus mode for FY21. So actually all these numbers augurs very well for India in terms of a strong and better investment destination. This is some of the facts of the Indian economy. India's industrial corridors is actually across India. You can see the global competitiveness index, the home to the youngest population. All these are positives for India. Now, in terms of the economic outlook, I think we actually maintain 2 economic outlooks. One is basically the GDP growth is already back in the positive territory in Q2. The numbers which was released on 26 shows a growth of 0.4%. We actually were expecting a growth rate of 0.3%. GST revenue has been more than the threshold 15 billion, which is basically is equal to 1 lakh crores. If I take 70 or 71 as the exchange rate, for the 5th successive month, it has been more than 15 billion, which is the threshold level. The high frequency indicators most of them are higher than the pre-COVID levels or even the pre-COVID peak levels. Our business activity index, which is basically an index, as you will see on the red curve, which is an index which shows the activities which when we are indexing it to 100 in February, they are all now greater than 100, showing that the SBI business activity index has also jumped. So, and there is also the acceleration index of all the indexes also going up. So all these things show that Indian economy is firmly on the path of recovery. This is the Indian economic outlook, which I wanted to show. Economic outlook, which basically wanted to show the combined WCPI. As you can see that this inflation outlook is positive. The IIP growth has also come back into the positive territory. The EUA bills, which is basically a movement of the bills generated between the state borders, which had declined by 150% in the month of April, is now growing in the positive territory. So this shows that the recovery has been very sharp for the economy on the aggregate. This is the composition of the current account balance. If you look into the equity inflows from FIs into India in 2020, India was only in the positive territory. All other countries actually you can see was in the negative territory. India's debt service ratio is comfortable. The external debt to GDP ratio is stagnant, and the ratio of short-term debt to total reserves is actually declining because India is now the 5th largest country in the world in terms of foreign exchange reserves. Our foreign exchange is currently at 584 billion, which is the 5th largest in the world. So that is also another the factor in India's positive outlook on the external sector. This is the India's economic outlook. This important point is that if you look into the composition of the imports, the inside one is the April to November 2019, and the outside is the April to November 2020. The outside, if you can actually, the important point is that there has been a significant deceleration in the petroleum imports in the current year. Obviously, the lockdown was one of the reasons. But the important point is that there is also a decline in the electronic components imports, which are coming down. And this is basically a conscious strategy of the part of the government and the RBI to discourage the imports from China. And that's why the Indian exchange rate, which is appreciating against US dollar, is actually depreciated against the Chinese yuan in the last couple of months. That shows that it may be a conscious strategy to discourage imports from China, because the government has embarked on an initiative of an Atmanirbhar package whereby to make our industry more self-reliant. And there is nothing wrong in it, because if you look into the experience of US, which is in 2008, when US actually turned inwards for shale production. And take the example of China. When China grabbed the lower end of the manufacturing products in 2008, India in 2020 is trying to do the same thing. It is trying to grab the lower end of the manufacturing scale and also turn inwards so as to become self-reliant. So this self-reliance has nothing to do with protectionism, which is sometimes one of the maybe one of the points which has been mentioned by some of the people, that India may be turning inward, but which is actually not true, because both of them complement each other. And self-reliant India and an India which is basically on its Atmanirbhar part. So these are basically the important points. And again over here, you can see that if you look into the two concentric circles, you will see that the product growth from the you will see what is the product growth. You can see that the drugs formulation products have actually significantly going up from 5% share to 7.1. That's why India today is being called the pharmacy of the world. And today morning, I'll just share a very simple joke. Today morning at 6:30 a.m., the Honorable Prime Minister had taken the first vaccine. And after taking the first vaccine, he actually, after that news came through, there is now a B for taking the vaccination for people above the age of 60. As I will show to you, India's vaccination drive is also going on smoothly, but it needs to ramp up a little. Bit of pace the way it has been moving. But I think there is also this India becoming a pharmacy of the world. That story could also become an important component of India's Atmanirbhar package at a future date. Now coming back to some of the data, and before I will come to the discussion on the budget, is the increase in financial savings. As you can see, that the important point is that why I want to show you this slide is that, as you know, that the budget has laid a lot of focus on the infrastructure sector. In fact, if you see the one of the points is that, which we have been mentioned, is that we call the budget actually a CSR budget. I'll come to that CSR budget, why we'll call the CSR budget. But the important point is that the household financial savings have actually gone up significantly in the pandemic, which is now 21.4% of India's GDP in Q1. This number could have stayed at the same level. And with a GDP, if the GDP of around 200 lakh crores, basically, which means that India's GDP is around 2.7 to 2.8 trillion. So if you take 20% of that, that's a very sizable number. And this is important because India is, this budget has laid a lot of focus on infrastructure. So this amount of savings could go in financing the infrastructure. What was the reasons for this jump in infrastructure? Obviously, some of these were accidental because people are unable to spend. So they consumed. They could not consume, so they were forced to save more. And some people also raised their precautionary savings because of the uncertainty of their incomes. And also there were some elements of job losses. But the good thing is that this saving is going to serve India in good state. And this has already arrested the pattern of declining household savings, which has been happening on the last couple of years. So possibly this is the one of the most important things which has come out from the this pandemic accidentally, but is going to help the Indian economy enormously. The other important thing is that, and this was one of the reasons why the Indian economy expanded so well during the pandemic. I think if I just take a moment and say, I think for the first 3 months, as you know, the Indian economy witnessed one of the strictest lockdowns. That is one of the reasons that I will show that why India's response to COVID has been so good. And I understand that Israel has also been able to vaccinate a large part of its population, and that is one of, that is one of the responses which we wanted to also talk about if we have time. But the important point is that in the first 3 months when the economy was locked up, after the economy was opened up, what happened was that there was a rapid transport of goods across the boundaries of the states, which was witnessed in the trade, hotels, which was witnessed in the communication and communication sub-segment which within the service sector, and that also included the communication, telecom and data part. So basically what happened is that India, which was locked up for a significant period of time in the first 3 months of the current fiscal year, after it was open, there was a significant surge in the transport, storage, communication sub-segment of the services. And that is the reason why the number of mobile subscribers which we lost during those months, the number of the data which was consumed in the lockdown, that has all increased at a phenomenal speed in the last couple of months. This data is maybe a little, I mean, this data actually shows that the total consumption of the data, wireless data, has significantly gone up, and that is one of the change in the behavioral habits which happened because of the lockdown. But anyway, this was one of the reasons why actually it led to an increase in the economic activity at a much faster pace than what we were anticipated. The other thing is that this I'll show you the numbers over here. The point is that India has tackled COVID much better than its population. Look into this graph for today. India reached its COVID peak on 16 September 2020. After that, the cases have declined, even though the cases are currently rising right now, but they're still in the range of 15,000 to 17,000 around. Actually, what we did is that I'll not get into the technical part, that we actually did a two-stage B-squares model. That is an econometric technique with 20 major states by taking the actual data. So what we did was that we looked into, and where we actually used population as a variable. So we assuming that population, if the population was the same across all Indian states, so then what would have been how India had controlled the vaccination, how India has controlled the pandemic. The results of which is basically was updated till the end of January are revealing, which shows that India has been able to lower its infection by at least 3.4 million. The economic survey says this figure could be 3.7 million, but that hardly matters. The model estimates, which we have calculated based on actual data and actual testing, actual infection rate, and the population data, shows that India, being a country of 130 crore population, has done remarkably well in terms of controlling the COVID population. And this is the state-wise data. You can actually see that some of the states like Uttar Pradesh, which is the size of Brazil, and some of the states like Bihar, these states which a poor health infrastructure has done remarkably well than some of the largest states, say like Maharashtra, which is a better health infrastructure. But on a net basis, India's COVID tackling has been very good, even if we go purely by data interpretation. And this is India's position vis-a-vis other countries. I can give you India's numbers with, say, US and other countries. In UK, the US number of cases are higher than India. If we make a comparison, is increased by 100 lakhs. So this is on a comparable scale, even though US health expenditure and the number of beds are much higher than a country like India. So it is clearly visible that the India, even though has lower health government expenditure and less number of hospital beds per 1,000 population, India has done much less number of COVID cases. The credit for it should go to the government and also to the people of the country, who actually has been very resilient in going through this crisis. That, I mean, and I don't know, I mean, sometime back, there's also data in public domain. In 2018, the total number of cases, smallpox cases in India, you know, that was around, the pneumonia cases, sorry, were around 4 crores. 40 million people were infected with pneumonia in the year 2018. This is as per government official data, but the number of deaths was only around 3,000. So basically, Indian public has always been resilient, and perhaps this is one of the reasons why the COVID could not tame a country like India. And we were able to, and India was perhaps the only one country which posted a positive growth rate in the third quarter, in the last quarter of 2020. So this is basically the most important point which I would like to mention. This is the speed of the vaccination. You can see the speed of the vaccination. India's vaccination only started from 16, but we are going at an exponential pace. We are already we have already overcome the world. We had 13.5 million had been vaccinated from India out of 225 million people who were vaccinated in the world. So that's an advantage this is doing. Today, after the Honorable Prime Minister has taken the vaccine, I think there is a significant demand for people to take vaccine. And if this continues in the next 2 months, I think that will be very good for the economy. So it will mostly a vaccination-led recovery also. Now, having said all this, let me now set and this has set the context for the discussion on the budget. I will have a discussion on the budget right now, which will give you an idea of what India has done in the budget. The most important point is that India's real growth in capital expenditure, I am talking in real terms, is 21% in 2022. And the revenue expenditure growth is supposed to decline in 6.5%, which is basically growth positive. And do you know that if I give you some numbers, for the last 20 years, India's growth in capital expenditure, if I go by the Indian figures, the Indian rupee was around 250 Indian rupees in India's billion terms, rupees 250 billion. But this year, the total number of the increase in capital expenditure is 114 lakh billion. So that means that is 4.7 times higher than the historic increase in capital expenditure for the last 20 years. And that is the most positive part of the budget, because the capital expenditure growth is always growth multiplier in any context. The fiscal arithmetic of FY21, if I look into, I think as all of you know that there was a significant amount of revenue loss of 120 billion, but there was also an expenditure increase of 56 billion. But the important, so basically the fiscal deficit of India has increased from 109 billion to 253 billion, but 75% of the expenditure increase of FY21 was because of food subsidy. And this shows the human nature of India's response to the pandemic. We ensured that none of the people on the India actually went hungry. And that's why India spent 42 billion of its total amount in food subsidy, which was, I think, one of the best responses to the pandemic for the poor people. Because as you know that in India, there is this debate, but India actually managed this very adroitly during the crisis. What are the things important in the budget? As His Excellency, the Honorable Ambassador was saying, one of the numbers which is very important is going to be the increase in the non-tax revenue. What is non-tax revenue and other receipts? Basically is the receipt from the disinvestment receipts and from the telecom receipts. Today the telecom receipts have started, telecom auction has started today. In the disinvestment receipts, the numbers are also, actually the government talks about privatizing 2 public sector banks and 1 general insurance company, apart from going through the Air India, apart from going through the, if you just give me a minute, there's sorry. So basically, so the important point is that the total tax revenue is going to be the most, the total increase in the disinvestment. This is going to be important. The Air India disinvestment receipt, the life insurance disinvestment receipt, all these are lined up, and we are sure that all this will go through, because the next slide actually. Just 1 second, the slide is, now it's going. Okay. The next slide is that instead of the tax revenue, the most important point is that all tax revenue are going to recover next year. This is, of course, the statistical artifact, because the last year the corporation tax count declined by 22%, the taxes on income declined by 9%. So 20% growth is absolutely feasible. This was the case in 2008-9 also, when the receipts grow in excess of 25%. And even though I'll tell that all these tax revenue assumptions are very pragmatic and reasonable, this I will explain in the subsequent slide. This is basically India's historical tax buoyancy for the last 18 years. So if you see, the tax buoyancy is always the growth in nominal GDP to the growth in tax revenue. You can see that in FY22 budget estimates, the total growth in gross tax revenue was actually, this year the tax buoyancy is estimated at 1.2, which is lower than, next year is 1.2, which is lower than the FY21 revised estimates of tax buoyancy, basically this year. So we are actually projecting a tax revenue buoyancy, which is even lower than a pandemic year, which I find to be a little bit surprising. But at the same time, it gives us a satisfaction that these numbers are extremely reasonable and pragmatic. And that's why, I mean, the fiscal deficit estimates which are put out in the budget, when they will be finally revised in May of 9.5%, I can come back in a May seminar to you and say that these numbers were actually on the numbers should actually be much lower than the 9.5%. And that is why I still maintain that the budget numbers are actually much more pragmatic, and you will see a surprise in the numbers when they are released finally released in the month of May. This is the disinvestment target. Even though the disinvestment target at 25 billion is steep, but this government had the unique distinction of actually meeting the disinvestment target in FY18 and 19, even though they were very steep. FY21, it was a different story because of the pandemic, but in FY22, we're sure that is going to make the disinvestment target, and that is going to be very positive for the economy. Now, the important point is that the government, we call it an CSR budget. CSR, as always, is known as corporate social responsibility, but we call it a CSR budget because it shows that C means consolidation, S means spend, R means revive. So the budget actually shows fiscal consolidation. Why does it show fiscal consolidation? Because it has actually brought all the off-balance sheet items which was in the outside the budget onto the headline budget, and this number is actually significantly high at around 1.7 billion in the FY21 estimates, because the government wants to increase transparency in finance and reducing the off-balance sheet of financing. So this is the most positive trend in the budget. The other thing is that the government has shifted actually 22 billion from off-balance sheet to food subsidy. If we take out that off-balance sheet items from India's fiscal deficit, India's fiscal deficit is actually 8.7% instead of 9.5% in FY21. Important point is that even after taking out those off-balance sheet items, the government is still spending an additional, spent an additional 35 billion in the current years because of the pandemic, which is 1.3% of India's GDP. And let me tell you that this 8.7 point number, which is excluding the off-balance sheet items, could be even lower when the final numbers of fiscal deficit are announced in the month of May. This is the financing of the small savings. I think the Reserve Bank of India has been doing a humongous job in terms of managing the government borrowing program. The government borrowing program has been the largest in the Indian history, but the yield, the GSEC yields in the market has been the lowest in the last 16 years, which shows that how the central bank and the government has actually coordinated. I have a very interesting slide to show you at the end, which is called the game of chickens, but that is very interesting. But the important point is that the government, the RBI, has worked very judiciously and assiduously with the government so as to bring back financial stability to the market. Now, these are some of the borrowing numbers. The total, as I said just now, the total gross borrowing of the numbers is around 320 billion in FY22, and net borrowing is 252 billion. But the point which I wanted to say is that the RBI has taken a lot of unconventional and discretionary monetary policy responses in the last 2 years. And that has ensured that the yield, the cost of borrowing of the government is actually stays at the lowest level. In fact, it was stays at the lowest level in the last 16 years when it has done. The other important thing, and this is important, is in the last 3 years, there was sometimes criticism from the market that India's fiscal deficit of the center, and if you add the extra budgetary resources of the center, those numbers were significantly different. Look into this table. In FY20, this fiscal deficit of center and fiscal deficit, if we add the extra budgetary resources of the center, which the government actually had brought to the main deficit this year, were significantly diverged. For example, in FY21, in FY20, the number was 3.8 and 4.6%. In the current fiscal, this number was 9.5 to 10.2%. But now what the government has done, it has brought back all the EBR into this headline inflation. So the 6.8 and the 6.9 are largely coinciding, which is very good for the transparency of the budget numbers. In fact, the PSUs are also, there is a progressive decline in the extra budgetary resources of the PSU borrowing also over the years. So that actually shows a good amount, a good picture in terms of the fiscal consolidation where we are trying to achieve. Now, this I will not get into this one. Indian context, the fiscal policy has been traditionally pro-cyclical for whatever reasons. You take at the history of the last 70 years. There's a long chapter in the economic survey which has worked on it. But India's public debt is largely sustainable, because if you look into the difference between the nominal GDP growth rate and the interest rate, that has been always positive. There has been some decline in the last year because the nominal GDP growth rate will be negative. But my sense is that India's key to running the debt is basically India should have a sustainable primary deficit surplus. Hopefully, with the better the government borrowing program and better share, we will be able to achieve it in some point of time. As I said, interest payment as a percentage of GDP, if you look into these numbers, that has been constantly declining over the point of time. So India's debt to GDP ratio could be as high as close to 90% this year. But obviously that should not be a matter of concern if you look into parameters like interest payment as a percentage of GDP, and also the difference between the nominal GDP growth rate and the interest rate, which is important. This year, for example, the nominal GDP growth rate could be as high as 15%. And the interest rate, which the RBI is currently trying to signal on the G-Sec rates for 10 years, is around 6%. So this will ensure that the overall debt to GDP ratio will decline over the next few years because the gap has very much on the larger side. Now, what has been the budget done? This is the budget for infrastructure. If you look into the total capital expenditure of the budget, the total capital expenditure of the budget is around 76 billion, which is 3.4% of GDP. And in very technical terms, even if you're assuming a capital output ratio of 4.5, this could push up India's GDP by at least 0.8%. The second thing is that this year the infrastructure is on 3 sectors: roads, railways, and urban transport. The government has created a DFI, which is basically DFI is expected to create a book of 65 billion, which is basically implying a leverage of 25 or 5 times per year. And this is basically the sectors where it will come in. So it will create significant lending opportunities in the part of a bank like State Bank of India. In fact, we are already working on creating driving India's infrastructure ambitions. And this is the numbers which is most important, because this is a budget where the infrastructure spending is a significant emphasis on the infrastructure spending in the next fiscal. Other thing is that the health expenditure, there is a 137% jump in the health expenditure, the health and well-being of the budget. India's health expenditure as a percentage of GDP is now 1.8%, which is higher than countries like Indonesia and very close to countries like Malaysia. So we have to travel a distance, but this is a very good beginning, because this actually at the end of the day, if you spend more on health and education or investing in human capital, that will have a gala payback time in the near future. India's current health infrastructure, I'll not say, but the good thing is that there are now certain states like Sikkim, Jharkhand, Tamil Nadu, Andhra Pradesh, all are increasing their expenditure on health in FY21 on health. And that's a good sign, saying that India is now rightly emphasizing on health infrastructure. In fact, I'll give you one estimate, and I think this is one of the also the objectives of the government, that India has around 741 districts. So out of these 741 districts, there are 500 districts in India which doesn't have a super specialty hospital. So we calculated that even in these 500 hospitals, out of these 250 hospitals in 250 districts, if we have an 500 bed super specialty hospital, that will cost India only 200 billion every year. And I think this is one of the options which is also been significantly explored by the government. And our sense is that India has a very good program of Ayushman Bharat, which has been running, and possibly if we can upgrade our health infrastructure, that will be good for everyone in the country. What are the other proposals in the budget? The budget also has a significant emphasis on the MSME sector. MSME sector, there has been a lot of packages during the pandemic, because in the MSME sector, what has happened is that the MSME sector, what has happened is that there has been an emergency credit linked guarantee scheme, which has been very successful in India. There has been also the eligibility period to claim tax holiday for the startups has also been implemented. So that's also positive for the startups. The other important point is that states to agricultural support has been significantly enhanced. Agricultural credit has been enhanced to 230 billion. There is a significant jump in the rural infrastructure development plan, Operation Green Scheme. More mandis will now be linked with ENABs to bring transparency and competitiveness. In fact, the top 5 states of India now accounted for 60% of India's mandis. The APMCs will be modernized. There will be fishing harbors. There will be also multi-purpose seaweed park, which will be established in Tamil Nadu. So a lot of opportunities even for a country like Israel. In fact, I remember in 2016 in our State Bank of Economics, Banking and Economics Conclave, we had an Israel professor who had joined to support the success of Israel in its agriculture initiative. And I think that was a wonderful presentation. But our aim also, and I'll give you some slides about the recent agricultural legislation, but the point is that the government of India is trying very hard to ensure there is a farm to fork benefit to the farmers in their price discovery. The tax proposals are very good. Senior citizens above 75 may not have to file tax returns. The banking sector will take the necessary infrastructure. The EPF interest income could be taxable, but the finance minister is saying is that there could be some tweaks to it. There is a cess which has been involved on the agriculture on the petroleum and diesel. which will be used for the furnishing the infrastructure, and affordable housing will be given a boom where a lot of NRIs invest for 1 more year in terms of a tax benefit. So all these are proposals which is going to stimulate demand in the sector. Specifically the last one, the proposal related to the banking, the most important step is the initiation of the asset reconstruction company, asset management company to clean up NPAs in the banking sector. I think already our bank has been working vigorously on this, and this was one of the suggestions which we have made to the Honorable Minister. And in fact, our DMD sir was a part of this committee which had recommended these changes, and this has been accepted by the government in toto in this budget. We are now working out the modalities of setting up this one, but let me tell you, this could be a game changer because most of the assets have already been provided for through provisioning. So therefore, there will be a lending leverage, there will be a recovery leverage, there will also be a benefit in the terms of no provisioning could be done, that could have an impact on the bank balance sheet. There is also this capital infusion. Depositors also will be able to get immediate access to their deposits. There has been some tweaking on the deposit insurance scheme. And as I said, the development financial institution is going to be set up. The other thing is that the FDI and insurance sector has been increased to 74%. This is going to be very important because this may push up the insurance penetration in the country, which is currently staggering at 3.76% compared to the world average of 7.23%. In fact, the steps which the government of India has taken for the insurance sector in terms of all those coverage, I think that has also helped in this insurance benefit, but it can go up further. We in fact expect that the total insurance, total FDI inflows into the country in the next 1-2 years could be around 2 to 3 billion. Apart from building up deeper product expertise and better underwriting skills for the insurance sector. So these are all positive for the insurance sector. The most important point is that the asset quality has significantly improved from the banking sector. As I can say over here, is that all banks have now provided for the bad loans. The CASA ratio of Indian banks are significantly better. State Bank of India is leading the way in terms of reduction in gross NPA. Our net NPA is actually close to 1%, meaning that all our provisions are covered. We have the highest provision coverage ratio in the industry, close to highest at 90.2%. And this has been continuously increasing. So that's why I'm saying that the ARC which will be set up will be very much positive for the entire banking system. So this is other thing. The other important thing is that there's a significant improvement on the corporate earnings. The small companies have been more vigorous in cutting costs. But the bad side of it that when the employee cost has been rationalized significantly, so there has been reports of some job losses, some salary income losses. But the good thing is that as we speak to several people right now, some of these jobs are getting established. Some of the salaries are now getting getting at the same level. So that I think is good. And the third quarter results, which is now ongoing, October to December, which is now being announced, steel, cement, IT, FMCG, pharma, capital goods, all are showing better growth across numbers in Q3 FY21. This is another important point. As we have said in the beginning, that the banking sector and the RBI has all worked together to bring back a significant discipline in the corporate borrowings in the system. And that's why the leverage has been significantly reduced. And that's why in a year, and that's why Indian banks have actually went into the crisis with better provisioning, better capital support. So therefore, again, I repeat that the banking sector will be the greatest surprise which will come out of this crisis. And this is why one of the results that SBI shares actually have hit the, the trading was suspended in the shares after the results were announced for a day because SBI shares actually had hit lifetime high. So it is not to say that it is not to describe the State Bank of India shares, but it is just to say that this represents the growing optimism within the Indian financial sector in the current year. And that is why we are also very optimistic of a continued strong economic recovery. This is another important slide. If you can look into the improvement of the credit ratio, last 4 months, metals, steel, cement, gems, financials, all sectors have witnessed rating upgrades, even though the upgrades are still done downgrades. But this actually augurs very well in better improvement of credit ratios. That means the corporate quality of the corporate credit has also improved, even though the pandemic has struck every one of us with the same ferocity. This is another important slide. This was till 2nd February, the total market capitalization which was added to the Indian the sectors were around 756 US billion, of which financial services, IT, oil and gas, consumer, all sectors have actually gained well, even though there is always a lot of debate that sometimes the real economy and the financial sectors may not be linked, but you must know that the financial sectors, the stock markets are always a barometer of having a discounted cash flows. So there must be seeing some the future in the company. So that's why the share market has been going up at such a level. But of course, I mean, it's always a point of debate. But the important point is that the stock market has been very buoyant during these years. I'll stall out some of the softs for the NRIs. I think there has been also some soft for the NRIs. The government has now allowed NRIs to incorporate 1% companies in India. The government has also decided to eliminate double taxation. Affordable housing is bodes well for the NRIs, as I've said then, because a lot of this affordable housing is actually the NRI invest in them. So I think this is very positive budget for the NRI sector also. Now, before I conclude, I'll talk about this slide at the last, but let me tell you some food for thought, what the farm bills intend to achieve. I think there has been a lot of talk about this farmer production bill. I'll give you a description, but let me give you some facts over here. I think the agitation about the farm bills, unfortunately, there could be a lot of politics behind it. Look into these numbers over here. I mean, India follows a procurement system which is somehow asymmetric. States like West Bengal, which is the largest production of rices, the procurement rank is only 10. But states like, for example, Punjab, which is the production rank is on the lower side, 3rd, their procurement is on the higher side. And if you look into the mandis which are registered on the INM, you can actually see that the number of the mandis on the INM for a state like Punjab is very much on the lower side, because they have an assured income from the FCI, which procures all their cereals which they produce. In fact, the number of INM mandis are very less in Punjab and Haryana, which is 118 out of 1,000. This is a mandis which are registered on INM. So this is basically gives you an idea that the politics behind this one. This is the average annual income of agricultural households in India. The average Punjab income of Punjab and Haryana reaches in the country almost 2.5 times of Indian average. So this gives you a completely lopsided picture of the annual income of agricultural households in India, which the government is trying to correct through some changes. So some changes. Now, this is the output per hectare. The food grain has lower estimated per output per hectare. So therefore, we have to, cereals value of output per hectare is very low. So we have to finally, shift to fruits and vegetables and the coffee rather than continue to produce the cereals and pulses, which are not rewarding. Now, the other thing which I think the Honorable, His Excellency wanted me to seek on production net incentive scheme. Yes, this is a very good scheme. Total $2.02 billion US dollars are going to be over these ministries, and these are the outlay. And this will be a financial outlay of 20 billion over a period of 5 years. This will create a large scale jobs, and these are the sectors. So I think this is one of the most important developments which the government has launched in terms of the production link incentive scheme. Basically, the more you produce, the more you get the incentives, rather than just getting a subsidy out of it. So I think it's a novelly thought out subsidy scheme which the government has introduced.
So
I'll talk a little bit about the
Mr. Dr.
I'll talk a little
that you first need to invest and then you'll get money back.
That's yes, of course. Scheme. Yes, and then I'll talk out a little bit about the India-Israel trade relations and opportunities. India-Israel bilateral trade, if you look into it, it has been growing, Indian exports, and India's trade balance at this year is, I think this year is an aberration, so it's around 538 million. So I think there is a significant scope for India to grow, and India is a focus country for Israeli government's increased trade efforts, and this is actually an India runs a trade surplus with Israel. So I think that's a very positive part. And these are the commodity-wise Indian exports. India exports pearls, minerals, electrical machinery, and the products which India imports, basically fertilizers, then APMCs, I mean optical for photography and all these things. So major exports from Israel to India includes pearl and precious stones, chemical and mineral products, machinery, electrical equipment, base metals, and of course defense. So this is basically some of the thing of imports and exports. What are the sectors which could offer greatest opportunity for Israel? Cyber security, space science, water technologies, homeland security, real estate, agriculture, chemicals, and even defense technology. I think defense and agriculture are the two sectors which could give enormous benefit to India in terms of having opportunity with having co-branding with Israel. And the final thing is the RCEP. I think I had written about RCEP in the press several times, just to say that RCEP is actually was not beneficial to India because a lot of these issues are still unresolved. India has run on, just for your own example, India has run on merchandise trade deficit with 11 out of the 15 RCEP countries in India. And India's, as you can see this, India ran a merchandise trade deficit of 11 out of the 15 other members of the RCEP in 2018-19, totally 107 billion. India's overall merchandise trade deficit was 184 billion in FY19. In 200 and FY19, 34% Indian imports were from this region, while India could export only 21% to this region. China has the biggest trade partner among these countries, and the major concerns that India had throughout the negotiation were with regard to China. So India has actually not joined RCEP in its own interest. There are examples like ratchet obligations, the move towards 2014 as the base year for traffic reduction, auto trigger mechanism. So there are some of the issues which has been not resolved to India's satisfaction, but hopefully once it is resolved, India could become a part of this RCEP. So this is what I had to say. Before I say, I'll talk a little bit about this game of chicken, which is basically one of my favorite subjects, which talks about how the Indian economy has been able to recover in this pandemic. I think if two drivers are actually driving on the highway, and if both the drivers are egoistic, what they can do is that just 1 second. Yeah, if both the drivers are driving actually on the highway, so what could happen is that both the drivers are very egoistic, saying that why I will swap, let him the swap. So then both of them decided to collision against each other and go head on. So in this case, both of them has a payoff. This is in economics called a payoff, which means both of them are dead with a -10, -10. But however, is one of the driver is not egoistic and he decides that let me swap, but the other is still egoistic. So it could be either go head on and swap, the bottom left hand corner, or the top right hand corner goes head on and swap. So in this case, the outcome could be a little better for those. It could be a little better for the person which is basically going head on and who is actually swerving, because if he is going head on, he benefits, and the person who is swerving, he loses, because he is actually, and this is called chickening out. And if both of them swap, there is no payoff, but both, that is actually the best thing to happen to the society. The important point which I want to make over here is that even though the central bank had the largest government borrowing program in the current fiscal year of around 12 lakh crores, the RBI had ensured that the debt management policy was taken to its right conclusion. It had ensured financial stability to the market. It had ensured the fastest transmission. It had ensured lowering of the credit spreads. So basically the RBI has actually chickened out in swerving so as not to go head on collision with the fiscal policy. But at the end of the day, both the government and the RBI has swerved so as to keep this fiscal and monetary coordination together. And I think that has been the greatest benefit which India has learned from the pandemic, that if you work together, you can solve a lot of the problems which the country is currently facing. So I'd like to end here and by saying that the Indian growth story remains intact, and next year you will not be surprised if you see an total nominal GDP growth rate in excess of around 12 to 13%, and basically total real GDP growth rate around 12 to 13%, and nominal GDP growth rate could be as high as 16%. But the important point is that the nominal GDP growth will be clean, because it will be mostly driven by your real GDP numbers, as opposed to what happened after the financial crisis, when we had a bloated nominal GDP figure, but that was primarily because of the inflation. So I would like to end here and take questions from you. Thank you.
Thank you. Thank you, Dr. Ghosh. We'll start with my question, and my question is the rupee. What are your projections to the rupee? Would it stay on the 73? It will go up or down?
Yeah, can you hear me?
Yes.
Yeah. See, in terms of the rupee, what I can say is that the rupee actually is going to appreciate from the current levels. The central bank, there has been, as you know, there has been significant amount of capital inflows into the country. The dollar has been depreciating in the major currencies. And I can tell you that if I come back in November and have a discussion, that the rupee will have an appreciative bias in the current context. And this is also important for India because crude oil prices are currently rising a bit. So it's better to keep the rupee in check so that the benefits of a stronger rupee, so the stronger rupee actually outweighs the losses, the potential loss from a rising crude oil on Indian import basket.
So you are saying that we're going to reach 70?
71, 72 could be the rate, I think, which actually you should look into. Should be, I think there is no point in there is no point in the saying that the rupee is going to depreciate from the current levels. But if you mark my words, there could be some disturbances, but I am not absolutely worried about the rupee at this point of time.
But just a word of caution is that the US yields are going up. That's something that we need to closely watch upon because the way in which the last 2 days, the 10-year treasury has moved up quite significantly. So that's going to have a bit of an impact on the flows. So, but by and large, I also go with what Dr. Ghosh had mentioned.
Okay. If anyone from the audience have questions, you can place it on the Q&A session. So far, Csr have asked for the presentation. We have recorded this session today, and whomever participate will be able to get a copy of the presentation, and you can go over on whatever you missed or you'd like to share with your colleagues. So another questions from the audience, now is the time, otherwise we will wrap. Mr. Ramanat, you have anything to address to Dr. Ghosh?
No, Anna, let us take it from the audience.
Okay. Okay. Dr. Ghosh, you spoke about the productivity-linked incentives. Can you elaborate a bit about this scheme? What exactly it means? I mean, I understand the general concept, but what does it mean maybe for Israeli companies? Would it apply for foreign investors?
Yes, of course. If anybody is setting up, I mean, as you know, that India's government is also offering tax concession to new manufacturing units. I think up to next year or so, I think around 15% is the one. So it is open to everyone. Anybody wish to take care of the production linked incentive scheme, and the total amount which the government is actually expecting is around 2 lakh crores, which is basically the US 1.5 billion, which I talked about over there. But I think this is a very good scheme, and this is open for anybody's participation. And the idea is to make India a manufacturing hub. As you know that China has vacated the low end of the manufacturing scale. The important point is that, do you know that India actually produces shirts? India actually produces shirts which are very costly in nature, but India imports shirts which are extremely, extremely cheap in nature. So we are actually producing clothes which are 1,000 rupees, but we are importing shirts which are 200 rupees. So the idea is that India should gain to the low end of the manufacturing base, and over a point of time, this is going to be extended to other sectors. So, and I think this is a huge area, low end manufacturing space, first capture it, then move it up, as China has done the same thing in 2008. And I think this is a very good idea on the part of the Indian government.
Thank you, sir. It seems that everything was clear because I don't see questions from the audience. Any of the panelists have a question to Dr. Ghosh before we sum up? Okay, I think that it was very clear. I'll pass the mic to my colleague, Raviv Byron, President of the Israel-India Chamber of Commerce, to give us a vote of thanks. Mr. Byron.
Thank you, Anat. Yes, I'd first of all like to say thank you, a warm thank you to the State Bank of India for organizing this session. I think it's been very enlightening. I think it's been very important for all of us to listen and to understand what is happening. Particular thanks to Dr. Soumya Kanti Ghosh for his very clear presentation. Special thanks to Mr. Venkat Nageswar from Bombay, and a particularly warm thank you to Mr. Ramana from the Tel Aviv or the Israel office, the Ramat Gan office of the State Bank of India. As Anat said earlier, the State Bank of India has its branch in Israel. It's been in Israel for many, many years and very well established. And I think anybody who's involved in India in any way knows that the State Bank of India is the leading bank in India and is very well known for excellent service. And I think Mr. Ramana is exemplifying this in Israel as well and can give a lot of benefits to Israeli business people who want to work with India. A very, very strong thank you also to His Excellency, the Ambassador of India, Mr. Sanjeev Singla. Thank you very much for your warm words and for attending and for supporting and for your general support of all this activity. Another warm thank you to Dan Kטריבס from the Manufacturers Association. We greatly appreciate the partnership that we have with you. And to Benjamin Grossman, thank you very much also for your support. And to all the participants, and of course to all those people who have attended and who've listened in, you're the reason we are here. And we appreciate that your attendance, and we appreciate what you've done. And last, but certainly far from least, a great thank you. Sorry, I forgot to mention the DCM of the embassy with all the support that you're giving us. Thank you, Nandini, very much for all your efforts. And last, but certainly not least, a big, big thank you to Anat for doing an excellent job in moderating this session. It's what's to be expected of Anat. We know exactly what she's capable of doing, and you've done a marvelous job again here in this session. So again, thanks very much to everybody and all the very best. And we have a holiday coming up in India, Holi. So we hope that we just had our Purim, and we hope that you have a colorful and enjoyable Holi when it comes up soon. Thanks very much to everybody.
Thank you, Raviv, for your vote of thanks. I'll conclude by mentioning that next week, our chamber is organizing a session with the leading women of Asia towards the International Women's Day, March 8th. And we will share with you more details about this session. Ladies are welcome. Men is also okay. Mark your calendar a week from now, same time. So you have said it all. I'll just, Mr. Ramana, you want to say something?
Yeah. Our colleague from Dr. Ghosh department would like to say a few words.
I think that there is no one now. I think you can conclude.
Okay, fine. Thank you, sir.
Thank you.
Yeah, please go ahead.
Okay. I'll conclude again by thanking everyone. Also, Mr. Satya Narayan that joined us, but his video is off, for your continuous support.
I'm there.
Well, good. I'm really happy to see you. I'm really happy to see you. We haven't met for a few months now.
Yeah.
And I look forward for more collaboration with your team. So thanks for
Definitely.
joining us today. And
Thank
of
you.
course,
Thank you.
Mr. Ashok and Mr. Ramana from the Tel Aviv office. Shalom, everyone. Thanks for joining. And we will share with you the recording soon. And I hope to see you, Dr. Ghosh, soon and continue our tradition.
Okay, thank you.
Bye-bye. Shalom.
Thank you. Thank you. Bye.
Namaskar, everybody.